There we go. All right, Tom.
Okay. Okay. So, good evening, everybody. It is, what's today? July 9th, 2020. Nice hot day here in the Delaware Valley, Pennsylvania. I'd like to welcome everybody. This is an overview and a Q&A period with Senior Analyst Scott Forehand of Symmetry Financial Group, talking about this debt-free life program that we've had available now for coming up on 12 months. Actually, just a recap, the company to date, when all the plans that have been put in place, our clients will have retired over $755 million in debt. They will have avoided paying about $243 million in interest. And probably most importantly, they'll have improved their overall retirement situation by about $1.995 billion. By now, it's got to be over $2 billion. Scott himself, he's been doing it for all along, about a year now. He's helped over 60 families, retired over $35 million in debt when those plans are executed, and improved his clients' retirements by about $100 million. Scott, you're going to do your presentation, and we'll have a little Q&A afterwards. Is that correct?
Yeah, but we've got today we're going to go into a little bit of an advanced stuff. We're going to skip the mortgage chunking part today, and we're going to go into daisy chain stacking, annuity stacking derived from debt-free life. So it's an extension, a way to leverage the debt-free life program.
I'm looking forward to it. And Scott, thanks for making yourself available. We really appreciate it, and appreciate everybody who took the time out to join us today.
Okay. Hi, everybody. Scott Forehand. Thanks for coming. Hopefully you get something out of this. You're here for one of a couple reasons. You're here because you were invited either by a Symmetry agent, broker, or underwriter. You are a Symmetry agent and you're looking to get some more information about debt-free life, or you're potentially one of my clients and you're here as an initial meeting. Welcome to this virtual presentation. If you are currently unmuted, please mute yourself. If you have any questions, type it into the chat window at the bottom, and we'll get to the questions at the end. So what is debt-free life? Debt-free life is, the words debt-free life is actually a play on words. This is a proprietary product from Symmetry Financial Group, and it is a way, a method, and a vehicle that you can use to get out of debt, create a beautiful tax-exempt retirement, and it's another way to create those retirement solutions where you're not going to be limited by the normal IRS restrictions as far as taking mandatory distributions and when you can take stuff and how much you have to pay tax on, and if you need the money too soon, you get penalized and all that stuff. So it's avoiding all that stuff. So the two questions that we're taught to ask initially are these that you see up on your screen. Are you 100% sure that you're going to have a great retirement, or do you have some doubts? And what if I could show you a way to get out of debt in 9 years or less, including your mortgage? That second question, there's actually, from what I'm seeing, it's actually should be worded a little bit differently. And the reality is it's not just 9 years or less. The end result is we're retiring all debt 15 to 27 years early. And I'd rather think of it that way. Because it doesn't always work in 9 years for people, but it always works at least 15 years early for people. So this proprietary product was created by Symmetry Financial Group in 2019, June. It just became available in June, but it is based on a solution that's been around for a long time, a concept called infinite banking. We'll get into that a little bit later. If you're like me, this probably describes you. When I first got here at Symmetry, this was definitely me. This is the average American. We spend about 34% of our every dollar on interest. We spend about 40% of our money on taxes. We spend about 3% of our money savings. That's for retirement. And 23% of our money, that's everything else. That's what we use to pay our power bill, gas bill, light bill, whatever. The issue is that this is not what we all signed up for. This is not the American dream. And if you are this person, if this describes you like it describes most of us, you've got some fairly large issues, meaning specifically that you've got, you're not saving enough for retirement. you're spending too much money on taxes and you're spending too much money on interest. Congratulations, you are the average American. This is another way to look at it. An average American makes about $2 million in their lifetime. This is not a small sum of money. This is a lot of money. As Americans, we make a lot of money. The problem is we don't save enough money. So one of the aims of this plan here at Symmetry, Debt-Free Life, is to get you out of that, off that hamster wheel and out of that scenario where you're not going to have enough money for retirement, and you're going to be reliant on the federal government and Social Security, which is questionable whether or not it's even going to be around 10 years, 20 years, or 30 years from now. So what we're going to do for you is we're going to change that number. We're going to change that amount of money that you have at retirement to be a much greater number, and we're not going to have you go get a second job to do it. When you're first looking at different debt elimination scenarios and you talk to a bunch of different people that are quote unquote experts in the industry, they're going to tell you a couple of things. They're going to say, go spend less money. Duh. They're going to tell you to save more. They're going to tell you to go refinance stuff, consolidate your bills, work harder, go eat ramen and tuna fish, right? And all those things are kind of knee-jerk reactions, and they all might work. The debt snowball down there, if you do a true debt snowball, it should probably work, but none of these are foolproof, and doesn't get to the core problem. And there is a better way, and that's what we're here to tell you. So if you want to change your course in life, where you're going to be, then you have to change the way you spend money. And that's what we teach here, and that's what Debt-Free Life is all about. It's about teaching you a different way, a better way, a more efficient way to spend your money. More importantly, it's teaching you a way so that you get to reuse your money, so you're not using it just one time. So where we are on the left, that's all of us. Where we're trying to get on the right. The key thing to take out of this is that if you do one of these programs, we're going to increase your retirement income by about 500%. We're going to decrease the amount of money you pay in taxes over time by about 25%. We're going to decrease the amount of money you spend on interest by about 35%. And probably one of the most critical things here is we're going to increase your lifestyle money. That's the money that you have left over at the end of every month. So right now, if your checkbook or checking account looks pretty slim at the end of the month, think about this. If you have $1,000 a month left over and we give you a 43% increase, this is what we're looking to do, that means all of a sudden you've got $1,430 a month left over. And that's what these plans are designed to do. It's not designed to create an additional bill for you. It's not designed to create an additional thing that you have to pay every month. It's designed to put you in a situation where your money's going to work better for you, and then you're going to use your money better. So the goal for us is to get you to here, where we're eliminating all your debt 9 years or less. I see a lot more often less than that. Reduce your taxes, increase your cash flow, put you in a situation where you might be able to retire early. Most of the people, if I talk to them early enough, 25, 35 years old, I can usually get them retired before they're 55 or 60. And then obviously we want to reduce the amount of interest that you're paying over time, because that's horrendous for most of us, especially when you take a look at an amortization schedule and see how much money you're paying over time. So one of the key things that's different about this type of plan, there's other plans that have come before us. They've been out there for a long time. This is not new. It's been around for 100 or more years. The problem is with most of those other plans, or actually all of them, they didn't take into account all the what ifs. And I'm sure that I can't say that we've taken into account every what if, but we've eliminated all the other what ifs that were out there. One of the biggest things that we saw with some of the other solutions that came before us was that there was not a true emergency fund. So simply, most of the time they would say, and just remember, keep at least 20% in your plan, because that's going to be your emergency fund. And one of the things that we practice is out of sight, out of mind. So if I've got money in my wallet, there's a real good chance it's going to get spent. Okay. But if I've got money in my back pocket, not in my wallet, then I'm probably not going to know it's there, and I'm probably not going to touch it. So what we've done here is we've created this solution that incorporates a 20% emergency fund. The money is there. It is in your plan. It's in your portfolio. You just don't see it, and we don't want you to see it because we don't want you to use it. Okay. So, because the last thing in the world you want to do, and I keep saying this, it's still funny to me. I'm going to say it again. You don't want to run into that emergency jet ski issue, and then all of a sudden you've got the money available for that emergency jet ski purchase, and it's very tempting. Okay. So we put it someplace where you can't see it. Rest assured it's there. Rest assured it's earning money for you. Rest assured it's growing, but it's not something that you're going to easily put your hands on. So let's look at this when we compare this to other types of retirement vehicles. So a Roth IRA and a traditional IRA are those two columns on your right. A column on your left is the tax-free column. That's our column. So this is the difference between paying money on something, paying the taxes on it upfront, paying taxes on it upfront, and then having to pay taxes on the interest as it grows. That's the Roth, or paying no taxes and letting it grow and paying all the taxes, which are also growing in the end. That's that tax deferred column. So which one's better for you? Well, it's a no-brainer for me. And these are all real numbers using real 28-year histories of how the market has performed. And this is using one of our basic carriers here that we have that does this plan. There's 3 of them. And it's hands down, it's a no-brainer. The tax-free solution hands down outperforms the tax-deferred IRA and the taxed IRA, the Roth. The system is divided into 3 phases. First phase is the maximization phase. What is that? That is where we are taking a hard look and having in many cases, a difficult conversation with you regarding your debt. It's not being judgmental. Everybody's got it. We all go through it. We're taught from a very early age that it's okay to have debt. You know, you turn 18, you buy a car, then you go to college, you take out student loans, you get married, you buy a house, you get the kids, you get braces, you send them to college. It's just more debt, more debt, more debt. And we are taught that it's okay to do that. So what we said is, well, what if there's a better way? And there is a better way. And the better way is we can plan for all that stuff. We can plan for the braces. We can plan for that car. We can plan for that house. We can plan for that college. And we can do it in such a manner that we're going to use the same money over and over to do it. And we're going to eliminate our debt. And that's the first part of this process, is getting rid of those debts, whatever they are. So that maximization phase is really, really focused on eliminating all your debt to put you in a position where you can start handling all those upcoming debts that you're going to have in the future, and put you into a situation where you don't have to go knock on the door of a bank and ask them for a loan and go through all that process of qualifying for credit histories and yada, yada, yada. With this solution, you become the bank. You are the bank. You are the banker, and you decide whether you are going to lend yourself money. And if you decide to do so, what interest rate you're going to lend it to yourself at, including, you got it, 0%. So that's the maximization phase. It's really just making your money, putting your money in a situation where it works more efficiently for you over and over and over. The accumulation phase, that's the phase after you're out of debt, and now your plan is rolling. You've created that massive debt snowball. All your debt's gone, but the snowball's still rolling because you were accustomed to spending a certain amount of money every month, and that hasn't changed. But now we're putting your money to work for you permanently. That accumulation phase grows and grows and grows until you decide, and this is where you get with your underwriter broker, you decide at what age you want to retire, and you can plan for that. Or you don't even have to be retired to stop funding the plan. You can stop it early too, and I'll show you one of those illustrations a little bit later. Finally there, the last part is that distribution phase. And this is the phase where you're actually taking money out of the plan for things like living, vacationing, buying that emergency Corvette purchase, all those things, whatever it is that floats your boat. It's your money. You do what you want to do with it. There's a maximum amount of money you can borrow, and you won't be able to exceed that. But the nice thing about it is, even if you borrow up to your maximum the next year, there's more. The plan will still grow even if you borrow your maximum once you've gone through the accumulation phase.
I'm sorry. Is there any slides? You referenced the slide, but I don't see any slides on my screen.
You don't see the three phases of money?
No. All I see is everyone's picture. Is there something I'm supposed to click?
Nope. There's something I'm supposed to click.
Now I don't see anything.
Brian, has it?
How about
I
that?
don't think you see your screen.
There we go. Yeah, now I see it.
Okay. So that's the accumulation phase and the distribution phase.
Hey, Scott.
Yep.
Would you go back just a couple of slides and let them see the breakdowns that you showed earlier?
Sure.
About 3% and.
Yep.
Yeah, I don't see anything now either.
Yep.
So
I'm getting to it.
okay.
See a slide down? Debt-free life approach. Somebody
Yes,
give me a thumbs up if you see it.
Yep. Yep,
Okay.
I see it now. Thank you.
All right, so this is the debt-free life approach. This is just going back. Most Americans are on your left side of your screen. They are overspending on taxes, overspending on interest, undersaving, and then what's left over is your lifestyle money, and that's where you're supporting your debt service and supporting your lifestyle. Where we want to get you is to the right side of your screen, where we've decreased your taxes by 35%, decreased your decreased your interest by 35%, increased your savings by 500%, and increased your lifestyle capital by 25%. So now let me get back. Sorry about this, folks. Now we're back. Okay, so there's your lifestyle. Been through that one. This is the 80-20 rule we were talking about just a minute ago. This is the different types of investment strategies you can use. A tax-free strategy versus a tax-deferred strategy like a traditional IRA, and a taxed strategy like a traditional IRA or Roth. This is the three phases of this system: maximization, accumulation, distribution. And now we're caught up. This plan, as I mentioned earlier, is not new. This has been around for a long time. Most of the time previously, though, this plan wasn't available to the general public because you had to have a whole lot of money to be able to get into one of these plans. So Walt Disney did it, Ray Kroc did it, Doris Christopher, Warren Buffett still does it with Berkshire. It's just a way to leverage money. But in this scenario, we're using a life insurance vehicle as the holder of the money and the grower of the money, which means we're not taxed on it because IRS tax code 7702 says all monies derived from a life insurance policy are tax exempt. In addition, the way that we structure these things to take money out of these policies are always taken as a policy loan, which means there's no tax on a policy loan either. And the loans are automatically structured to be paid back based on the dividend and the performance of the company that the policy is written with. So harnessing the power of life insurance involves a couple of those things I just said. But more importantly, we've got two key things I want you to take away from all this. First off is the tax exempt nature of this, which is what we just talked about. But more probably equally as important is the fact that this is insulated from torts. So you cannot be sued. A judge cannot order you to empty a life insurance policy. The IRS cannot tax you, cannot place a lien on, and cannot penalize you for taking money out of a life insurance policy. So this is one of the ways that the wealthiest people in this country have transferred wealth generationally through the use of life insurance policies. And that's something that we're now thankful that now that this program exists, we all have the opportunity to do that as well. So this is a couple of examples of some of the folks that we've helped. These are smaller examples, 84,000, 100,000, 73,000. It's still great. Ultimately, that $84,000 that that one family saved, that's just a combination of the taxes and the interest that they saved. If they didn't do this plan, that would have been the very, very minimum cost for them not to do this, which is they would have spent that $84,000. The idea that we're going to do, though, is we're going to put that on steroids. We're going to make it so that you've got a significantly increased cash flow and that you're going to have that maximally tax favored income at retirement. And from my perspective, there isn't any more favored tax income. There is not a more tax favored income than a no tax income when we get to that point where we're able to start taking it. One more thing, point of order on this one. With a traditional IRA and traditional 401ks and those types of retirement plans, you are limited as to when you can access the cash, retirement years. And in those situations, if you need to get to the cash early, you can, but there may or may not be a penalty. There may or may not be tax that you owe. Currently, we're on a tax hiatus for taking money out of those plans. Thanks to COVID. But the thing that we're pointing to here is that with this solution, there is no limitation. You can take the money anytime you want for any reason, and you don't have to ask anybody because, like I said earlier, you are the banker. So let's talk about what we're going to do. We're going to change the way you spend money. So this is the way you currently spend money. You make your money however you make it, whether it's in the form of a pension, if it's in the form of income, if it's in the form of a dividend, if you're an hourly or salary, whatever. However you make the money is how you make the money. When you make it, you make a deposit, it goes into your bank, whoever you bank with, Wells Fargo, Citibank, whatever. And then at some point, that money accumulates in there, and the bank, while your money is sitting in the bank, is making money with your money over and over and over and over. They're lending your money out every night, getting the federal funds rate or higher. The returns I've seen are anywhere from 1 to 24% on your money. And how much of that money are they giving you? How much money did they make with your money, and how much of it are they sharing with you? And the answer is probably zero. And what they'll say is, well, we're not charging you to keep your money in your account because you kept at least $2,000 in here or whatever, some silly nonsense like that. So this whole process is geared towards the bank using your money over and over and over again. And then eventually you get to the point where you have to pay one of your debts, whether it's a car payment, a house payment, whatever, it doesn't matter. But you get to the point where you have to pay a debt. And that's when you tell your bank, either in the form of writing a paper check or going into your bill pay system and paying your bill electronically, or however, you instruct your bank to send your money from your bank account to pay that creditor, whoever that is. And then your money has become their money, which means you're not, the good news is the debt's gone. The bad news is the only person who's made any money with your money is the bank. And the other bad news is you're not getting to use your money over and over again. So the debt-free life system that we use changes this discussion, changes the equation. And here's our proposition. In the same manner that you currently make money, you're going to take that money and you're going to deposit it just like you would normally, and it's going to go into your current checking account. And here's where we take a detour. So instead of you letting that money sitting there day after day after day, you're going to make your life insurance premium payment. Remember what I said, this is a bank, but it's the bank that's being held in a life insurance policy. So that life insurance policy is really a whole life policy. It's a special kind of whole life policy called a participating whole life policy, which means the owner of that whole life policy, because it's a participating policy with a company that allows you to receive dividends and pays dividends, you get to earn interest and potentially, probably, or in all three cases that we have, definitely a dividend on your money. One of the other things that this plan will do is there's going to be a specific kind of a rider called a term life rider. And the reason why we have to do that is because these policies tend to build cash quickly. And if that cash value of these policies exceeds the life insurance value of the policy, and it'll balloon up, then the IRS will say, wait a minute, that's no longer a life insurance policy. We see what you're doing. That's an investment. That's called a modified endowment contract, and we want our tax. Okay. So, in order to eliminate that possibility, what we do is we attach a term life rider to your whole life policy. And that term life rider is very inexpensive, and it provides a very large amount of life insurance. That life insurance acts like an umbrella. So the umbrella that we have here makes it so that the IRS can't call this a modified endowment contract, can't tax us on it, and moreover, they really can't see what's going on beyond the life insurance. So that's the purpose of that term life rider. And it is not permanent. It is only there for as long as we need it. Because the last part of the money, that premium payment that you make, goes to purchase what we call paid up additions. So let's talk about that for a second. What is a paid up addition? A paid up addition is a paid up life insurance policy, meaning that once you pay for it the first time, you never have to pay for it again. So let's assume that you just paid for a $1,000 paid up life insurance policy. How much is that life insurance policy worth tomorrow? $1,000. How much is it worth next year? $1,000. How much is it worth 20 years from now, assuming you're still with us? $1,000. And how much is it worth when you pass? $1,000. So the point is that it has permanent value that will never go away, and you don't have to do anything to maintain its value. So in the banking parlance, that's called a tier one asset. Tier one being the safest, most secure type of investment that you can have. And just as an example, Wells Fargo has 48% of all their assets structured in that exact kind of thing, structured in life insurance policies that they own, where they are the beneficiary on somebody at some point. There are companies out there called viatical settlement companies, which do nothing but go around and buy life insurance policies because they have value, and they'll usually pay you 5 or 10 cents on the dollar. So the paid up additions is where this policy really, really grows. And that's where the snowball that I talked about earlier is created. And when we do this plan, we structure the money that goes into your plan, your life insurance premium. It gets split 3 ways, like you see on your screen right there. Whole life is the base policy. Term life is the rider that expands the life insurance value so we can put cash in here. Paid up additions is where we grow our cash. That's our permanent asset that we're using. So finally, after we start funding this life insurance policy simply by making our life insurance premium payments, and it doesn't have to be a lot. I've done these as cheap as $125 a month, okay? It doesn't have to be a lot. Then what we've done is we moved that circle where the bank was previously making money with our money every night overnight. We've moved it up into our private bank, up into our DFL bank. And now we're having our money work for us permanently. One of the things I said earlier is the only time you're ever taking money out of this plan is you're taking it out as a loan. You're never taking out the principal, okay? So when I take money out of this plan, all the money that I've put into it is still there. Even when I take money out, the money I put into it is still there. It's still earning every day. And sometimes the carriers we use will do a monthly compounding. Sometimes they'll do an annual compounding. Just depends on the carrier. But the point is that we've moved that money out of our bank into our private bank that we own and we control, into our DFL bank, if you will, and we're letting it work for us. So now let's fast forward. Now let's say you've got that time. You have to make that. There's enough money in your private bank to pay off your car. Let's say you owe $1,000 on your car. So now you take a carrier loan from your bank. The money is still in there. You haven't moved it. It's still sitting in your DFL bank, but you've taken a loan against the collateral, which is the paid up addition. And then you've told your bank to pay your debt because you deposited that carrier loan into your Wells Fargo checking account or whoever you use. And finally, you tell the bank to go ahead and pay that debt, and now your debt is paid. So what's happened? This is the new version. This is our version of how you should do things versus the current way you do things. What's happened before, your money became their money. You used your dollar one time, you used your money one time, and it's gone forever. In this scenario, your money stays your money. You do not ever use your money to pay your debts. You're using the carrier loan. The carrier loan is paying off the debt. The debt is paid for. The debt is satisfied. Your creditor's happy. The bank isn't happy because they're not getting ready. They're not making money with your money as much as they were anymore, but you are now. Okay. So in that process of paying that loan, you may be thinking to yourself, well, yeah, well, if I take a loan, I got to pay it back. That's what everybody that I talk to says when they first see this system. What I will tell you is no, that's not the case. And the reason why it's not the case is because this plan uses a combination of guaranteed interest rates plus dividends. And the guaranteed interest rate plus the dividend is typically going to be higher than the loan cost on that loan. And the dividends are structured to pay down the loan by default. And if you don't have a loan, then the dividends are simply going to buy more paid up additions for you. So do you ever have to pay back your loan? No. There's a maximum amount of money you can borrow, which is 95% of your paid up addition value. That's the only limitation on this. And the thing grows like a weed once you get the thing started. So let's give you a couple of examples. This is a standard family example. This is a family I helped back last October. They nice folks. They have a fair amount of debt, including some student loans, a couple of houses because they were both previously married and they still had mortgages on the houses that they brought with them from the previous marriage. Got a lot of credit card debt, got some nice cars, the whole 9 yards. This is their debt. If they had the opportunity to write a single check and pay off all their debt at one time, they would have to write a check for $584,930. Is that their true debt? That is not their true debt. Their true debt, based on what they're currently paying, $767,000. That's almost $200,000 more than what they think their debt is. In addition, because of the student loan component, which some of them are in deferral right now, this particular family is going to be taking 40 years to pay off that debt. So here's what we did. We went and looked at all their debts. We figured out how much they were paying versus how much they were overpaying. We also looked at some of the life insurance policies that they had that we could replace. We also found that they were overfunding a 401k. They had a 401k that they were putting in 9% into, but the company was only matching 3%. So they were basically paying an additional 6% to lose money every month. So it didn't make any sense to continue doing that. And so all the money that we found for this came out to a net zero cost for them. They weren't spending to execute this plan. They weren't spending any more money than they were already spending in their current debt service and current lifestyle. We didn't tell them to stop eating out. We didn't tell them to go buy off-label brands of everything and start drinking water instead of sodas and whatever else they're drinking. We didn't tell them any of that. There was no lifestyle change at all. All it was spending their money in a more efficient manner. And by spending their money more efficiently and putting their money in a place where every time you save that dollar, it gets to work for you over and over and over and over again, we went from 40 years to 7.8 years. Now, this is not abnormal. And I've done a lot of these, and I've done them at different price points. So realistically, I've probably run 400 or 500 of these illustrations. This is not abnormal. I've seen them as low as 2.3 years. I've seen them as high as 20. Okay. But this is not abnormal. So what happens? In the first year, they're paying off a tremendous amount of debt. They're paying off almost half their debts. One of the things I want to make everybody recognize is these plans work for anybody. If you've got any debt, they work for you. The more debts, plural, you have, the better the plans work because that creates a bigger snowball faster. So if you've got 3 debts and they're both large debts, 30,000, 50,000, 100,000, it's going to be a while before your debt snowball can take a hold. And these plans work because we're incorporating true debt snowballing with infinite banking, creating this banking on yourself methodology, if you will. And this is how it works for them. This is what they were scheduled to do, pay $182,000 in interest over the 40-year period to get out of debt. Our 7.8-year plan got them out of debt in 7.8 years, saved them $70,000 in interest. hopefully you can see that bottom part of the screen. Not only did it get them $70,000 less interest paid and 7.8 years out of debt, which is 31.2 years faster, it created 4.8 million with an M dollars of liquid capital. And this family, the gentleman this was written on, is only 36 years old. So will he need to go to 40 years to make 4.8 million? If he wants 4.8, well, what happens if he doesn't want 4.8? Well, he can stop when he's 65. He'll have 3.03 million. Most people I know can retire comfortably on $3 million liquid cash, especially if you consider this. He's out of debt. They're out of debt in 7.8 years. So let's assume that he wants to retire at age 55. At 55, he's got $1.5 million sitting in this bank, liquid cash. He's still contributing, but let's say he wants to stop. He can stop contributing. He doesn't have to pay any more premiums at all. He can cut off the snowball and just take the money and run. At that point, instead of having this growth, look at this. We are 1.5 million at age 55. At age 56, we're at 1.648 million. We've grown over $136,000 in 1 year. We've only contributed $21,000. So what does that mean? That means if we don't contribute that $21,000, that means we've still grown $111,000 in 1 year. And that's just through the course of interest, the guaranteed interest plus the dividend. Okay? So does he have to wait till he's 70 years old to capitalize? No. Could he retire on $1.5 million liquid cash in the account? Probably, especially considering he's also earning $111,000 a year tax-free. Okay? That's the operative word here, tax-free. So moving on. Do you have to have a lot of debt to do this? You don't. Do you have to own a house to do this? You don't. So this is a nice young lady that I helped a couple months ago, again, back October last year. This young lady doesn't own a house. She's a college student. She's in a master's program. She works as a waitress. She doesn't have a lot of money to spend on a plan, but she has enough money to get a plan going. Because once we illustrate to her that she's going to be in debt for 40 years, which we know is not the case. We know she's going to get a raise later in life. She knows she's going to get the master's and start making more money. But the point is, while these student loans are in deferment, the interest rate doesn't go away. You're still growing, and it's horrendous what it does over time. So if you start paying them back sooner, and you can afford to start paying them back sooner, then you eliminate that huge nastiness that comes in at the end. So with her plan, she actually owed more interest than she was going to owe in principal on this. So what we did was we created a plan for her. Instead of 40 years, she's out of debt in 9.7. She's got an affordable plan, $350 a month. That's all this was for her. She can afford it. She's still going to school. She'll actually be graduating next year with her master's, which is great for her. And then at the end of the day, we created $603,000 of liquid cash sitting in an account when 40 years from now, when she will be 63 years old. But she doesn't have to wait. Same situation. In this case, she said she wanted to retire at 65. I said, no, let's get you retired at 55. So at 55, she stops making payments. And she's growing $22,000 a year. That's off a $350 a month plan, including her snowball, okay? But that's all this took, was $350 to get this thing rolling. And she's making $22,000 a year tax-free income for the rest of her life, which is the equivalent of about a $35,000 or almost $40,000 income, depending on the tax rate and where you live. So that is debt-free life. That's what it is, what it does. That's a cursory level of how it works. It combines infinite banking with debt snowballing. It makes it so that you can put your dollars to work for you permanently over and over and over again. And the nicest thing about it, it is a contract. So it's not up to guessing whether or not the plan's going to work. If you execute the plan as we illustrate, the plan will do exactly what it's supposed to do. Actually, that's not true. This plan that we show you, these illustrations that I show you, they do not illustrate some of the other tweaks that you can do to this program, including doing mortgage chunking or any kind of debt chunking for that matter. in addition, that savings column that you see here, that savings column represents a situation where we've got too much cash and we can't put that much cash into our plan anymore. So that means we have to put the cash someplace else. So we call it a savings balance. This plan, this illustration is illustrated with a 2% return on that savings balance column. My simple question is, why in the world would you put this into a savings account earning 0.5 or maybe 2% if you're really lucky, when you could simply start another bank? Just do another bank, get it rolling, and put the money in there instead. Have two. Or if you're a husband and wife, put one on the husband, one on the wife. If you're not insurable, that's okay. Put one of these on somebody that you have an insurable interest with, your daughter, your son, something like that. There's lots of ways that your broker underwriter can get you to that point where you're eligible for this. So what happens from here? So what happens from here is you guys need to catch up with whoever your broker underwriter is and talk to them. They can have these things run for you. They're going to ask you some pretty deep questions. You're going to need to fill out some financial information. It's confidential and it's not going anywhere, but we need that information. We need to know what your debts are. We need to know what kind of policies you have, insurance policies. We need to know what kind of retirement you have, because all these are places where we go find the money, if you will. So I'm going to stop for a second and answer some questions, and I'm going to show you the daisy chaining for annuities. I see only one question. It's a hi, hello everyone. If anybody have any questions, you want me to go jump right in?
Scott, I got a quick question for you.
Hit me.
When you were talking about tort reform, this being tort proof, my experience with my father and nursing home, is this something that can be cracked open by a nursing home? Can they insist
life insurance?
Okay.
Yeah, gotcha. And the idea here, this is where you get into that concept of creating generational wealth. So when the time comes, you're going to zero out the policy, right? Before you die, preferably, because there's still going to have a massive death benefit associated with it. So there's still going to be a big life insurance policy, but you're going to take all the cash out of the cash side, and you're going to start one of these on a grandchild or a great-grandchild, and you've just created generational wealth by doing that. Or you can start one of these on all your grandkids, and dump $10,000 into every one of them. There's lots of ways to get around this. The whole idea, though, is that if you do this, you will have an opportunity to create generational wealth, where if you don't do this, you will not have an opportunity other than maybe a life insurance policy, or if you've done really, really well investing. Okay? All right.
Thanks, Scott.
Yep. Anything else? Okay.
Scott,
hey, Scott, I'm sorry.
Okay. I was going to say.
What we got?
Hey, Scott, the question I do have is, I'm familiar with infinite banking, but not like a little bit differently than what you're talking about.
Course.
So them paying their debt off, are they withdrawing this money every month or annually?
So that depends on what you're doing. So for me, like I have different people that I work with. So I have a retired Air Force general that I'm working with. He's putting in $7,500 a month into his bank. He's pulling out $5,600 a month to pay all of his living expenses, his mortgage, his car payments, power bill, light bill, the whole 9 yards. So in that situation, he's pulling a loan every month. But when the time comes that he does that, he's putting in more than he's pulling out. It's constantly growing every time he makes a deposit, and the dividend plus the guaranteed interest rate exceeds the loan rate. So he will never be able to defeat the policy. And all he's doing is, instead of paying that $5,600 a month and having that money be gone forever, he's putting it up and then pulling it right back out. So this is kind of the same concept we're going to talk about with daisy chaining and annuity in just a minute. But same situation I had with one of my clients a couple weeks ago. She put in $10,000, pulled out $9,500 because that was her maximum withdrawal, because she just started the plan. Then took that $9,500, put it into her checking account, and then instead of spending $9,500 on her living expenses, she put that $9,500 and put it right up into an IRA. So she's leveraging the money in both places. Basically, she's got the money in two places working at the same time, earning an interest rate. So whether you do this, and it depends on the phase that you're in. whether it's the maximization phase or accumulation phase, or the distribution phase. That depends on how frequently you're going to take a loan from the system. So, and this is one thing this is where you have to plan it with your underwriter. We're planning with your broker. So, and every person is a little bit different. So I can't tell you what's best, because there is a best way. There's always a best way, but you just have to run the numbers to see the best way. Okay.
But just so I'm clear, we can withdraw it every month, correct?
Sure. The three
Okay.
carriers that we use, and one of the reasons why we use these three carriers is because there's no limitation on the frequency that you can make these loans. So you can withdraw every month if you need to or want to. It depends on what your purpose of this is. So I have a gentleman who does house flips. So what he does is he puts all the money to purchase the house in here, takes a loan, buys the house, puts all the money to do the renovations in here, takes a loan, does the renovations. And then he takes draws on the renovations as he needs it. So he's taking multiple loans a month as he needs money to go down and buy, the new money for the new roof or whatever. So, and then at the end, he takes the sale money, pays off the loan, and then he's off to the races on the next one. But the point is that by putting all his money in that way, he's captured the full cost of purchasing and renovating that home. It's permanently captured and permanently growing with a guaranteed interest rate plus a dividend. Okay. So yeah, you can take a loan every month if you want. You can take a loan once a year if you want. You can take 10 loans a month if you want. It doesn't matter.
And what are those three carriers that you use?
The system. What now?
What are the three carriers that you use?
The three carriers we use are Lafayette Life, Mutual Trust, and Foresters. And
Scott,
each carrier has a
why those three?
Why those three? Well, number one, all three of those carriers pay a dividend. Number two, each one of those carriers agreed to do this. So when this plan was originally rolled out, there were lots of insurance companies out there that wanted to do this kind of thing, but a lot of them were saying, well, let's do it with IULs, or let's do it with these other things. And the problem with with these other mechanisms to do this is that the numbers aren't known. So we had to use somebody where the numbers are known. I know I don't have to guess whether the market's going to go up, down, or sideways. I don't care when I use a participating whole life versus use an IUL versus use a home equity line of credit, like some of those other strategies would have used. So there's different ways that you can do this. The way that we do this takes all those 9 or 10 reasons that those other systems that came before us fail. And so, I mean, nothing's foolproof. The problem you've heard those stories about people that win the lottery, and then a couple of years later they're flat broke again. So the danger with this plan, the only danger I've been able to find with this system, is that when you are not accustomed to handling large sums of money, the temptation can creep in, and you can start spending money on stuff that you shouldn't be spending money on. That emergency jet ski purchase, that emergency trip to Tahiti, they don't exist, right? So that's that kind of stuff. Let me see if there's anything else. Yes, this is being recorded. We have kids and grandchildren we'd love to share this with. Sure. Okay. Yeah.
Can I ask one quick question, Scott?
Go right ahead.
Yeah. Would it be okay if you just quickly went over when you were talking about the income in there around the 20K? Somehow I wasn't connecting all those dots when you were doing that.
I'm not sure which part you're talking about. Oh, you're talking about on the DFL illustration where the income is coming from? Sure.
Yes.
So all that is just doing fast math of the delta. Let me see here.
I guess I don't practice as fast a math as you do, so
okay.
That one whipped right past me.
All right. All right, hold on one second.
No, finally, said Taylor's the place I know she wants to go in the first place.
Can you see the screen, or what do you see? No.
It was it looked like an email bank.
Yep.
Look like your downloads.
All right, you can see this now, right?
Yes.
All right, Peggy. So what we're talking about here is when I look at this client, okay, this client, if she wanted to start and retire at, for example, age 55. At age 55, she's no longer making payments into this plan. Do you see that?
Yeah.
At age
Okay.
56, her premium is 0. So she's no longer making premium payments into the plan. From age 55, where she was making a premium payment, to age 56, her plan has grown from $409,000 cash to $431,000 cash, which means that her plan grew $22,000 without her doing anything. That's where the math came from. Do you get it?
Perfect. Thank you very much. Yes. Awesome.
Scott, while you have this up, okay. While you have that up, I just want to make sure, because I think that sometimes it can be difficult to understand the concept in that house flipping scenario that you gave. So you've got someone who's used this to get themselves out of debt, and they've got a bank that's earning a guaranteed interest plus a dividend every year. And when they go to take money out to flip a house, they're basically borrowing from themselves, and they're going to be paying less interest than what they're making on the money.
Correct. They're going to be paying less interest than what they're on they're going to be paying less interest on what they borrowed versus what they're making through the compound and dividend.
And I'm trying to dovetail to the next topic, and that's what makes daisy chaining them so powerful.
Yes. Yeah, not only that, but then we're adding compounding to the compounding with daisy chaining.
So there we go. How is that for a segue?
Yeah, not bad. All right, so let me get out of this. Let me get that part set up. So you guys, I apologize in advance. All right. So, because this is the first time I've done this, and my my illustrations are not up to snuff yet, so this is not very pretty. I apologize.
We're the guinea pigs?
You are the guinea pigs for this particular. It'll be prettier next time I do this, but right now it's not. Okay, so all right. So I'm going to show you a sample DFL illustration that we're going to use as an example for this. And daisy chain annuity. Okay. So get you guys back. All right. Can you see the debt-free life illustration?
Yes.
Anybody?
Yes.
Great.
Yes.
All right. So this gentleman that I ran in today, this person does not exist, but this is very normal for what I'm seeing. This is someone who's 35 years old, got a house, got a car, got a couple toys, got a couple student loans, got some credit cards, and this is a normal debt service for this guy. This person has a total debt of 225, which is actually 316 once you look at the true debt with the interest and taxes. The plan that we did for him, 8.6 years, pretty much a normal plan. But here's the thing. Got a good retirement, big chunk of change, almost $1 million in 30 years, completely debt-free in year 8.6. So let's look at this plan. So let's assume that this client wants to continue moving forward with this plan, but he wants to leverage even further the money that's in there. Right now, he's going to have $1 million sitting in this account in 30 years. Okay, that's right here. At age 65, $926,000 roughly. What happens if we start taking the money? So if you've been on any of these before, we talked about mortgage chunking and how you can start taking a $10,000 payment in these years, in between when you pay off your last baby debt before you pay off your house. That's this white area, this 4-year period where we're not paying off any additional debts. In that 4-year period, you can do mortgage chunking. Mortgage chunking, if you execute it, will increase the rate at which these plans work by about 10.6% faster. So if this said, as is the case, 8.6 years, 10.6% faster, maybe another year early, maybe a little bit less than a year. But the point is that I've got these 3 years where I can do mortgage chunking. So all I'm doing is I'm taking $10,000 chunks, throwing it at the mortgage, destroying the interest, paying 100% principal with those mortgage chunks, and really accelerating through my amortization schedule. So now I'm done. Now the house is paid off. Now what do I do? Well, the way this illustration works, you're just going to continue paying into the plan at your current snowball level or less. You do what you want at this point. And then when you turn 60 years old, you stop. And you've got money that's growing. In this case, this thing's growing $47,000 a year. Okay, you see that, Peggy? 730 to 777 with no contribution. Okay, so what happens if I incorporate chunking in a different way? And instead of viewing mortgage chunking, I take those chunks and I buy annuities. Okay, here's what happens. Can you see the new screen?
Yeah.
Look like a spreadsheet?
Yes, can see it.
Okay, so here's how this works. So this is 3 years. So don't forget, on this plan over here, we stopped at age, we just stopped, we started chunking. So in year 10 of the plan, we took out $30,000, $40,000. We have 56 in there, but we're taking out $40,000. The next year, the plan grows. It went from 56 to 91, so we're taking another $40,000. And the next year, we're taking another $40,000. So we're taking $40,000 a year for 3 years. And with each one of those $10,000 tranches, we're buying a single $10,000 annuity. And I use the Athene Performance Elite 15 as the example for this. It gets a bonus, accelerates over time. And once it gets to maturation, this thing will yield about $1,162 a year based on current projections. In addition, that $10,000 that you started with is going to grow to $23,371 over that 15-year cycle. Now, at the end, you've invested in this plan $120,000. That's a lot. So you've taken $120,000 out of your DFL plan over 3 years, and you've put it into 12 separate annuities. And it's critical that you do it this way. You structured these annuities so that they start at different times of the year. You basically want one starting every single month. You want to start a $10,000 annuity every month. So in the first year, you buy one each quarter. In the second year, you buy one in each quarter again, but 1 month early. And the third year, you buy one in each quarter each year, but 1 month earlier. So that way you got all the months covered in 3 years. You've purchased 12 $10,000 annuities. They are all rolling. They are all hands off. They're all growing. And the average, this is what you're going to see with each one of these annuities at the end of that 15-year run. So what had happened? You turned your $120,000, which you still have earning interest in your DFL plan, into $280,000, plus you're taking $13,900 a year additional income from it. So what happens? You had a 243% growth over the first 16 years. Or in the 20th year, you've got a 303% growth. So this is what I'm talking about compounding the compound. Your money is still in your DFL plan. Now you've got the same dollars in 2 places working at the same time. But by structuring it this way, you've created an additional income stream for yourself. And oh, by the way, if you take $13,944 per year, this number keeps growing because you're not going to annuitize it. You're just going to take the growth. This money keeps growing every year. This actually will still grow as well, but it's still income. So now the other solution for this gentleman, right? At 60 years old, he had $683,000, and he's going to stop. So let's say this guy wanted $1 million. What did I just do? 680 plus 280, that's 960 plus 13 plus 14. I'm real close to $1 million. And all I did was take $10,000 tranches out of my DFL and put it into an annuity. So
Dude, you so rock.
What now?
I said you so rock. That's just awesome.
Right. So this structure, so there's a couple key components to this. First off, when we're pulling that $10,000, we have to season the money. So it has to sit in your bank account for a while. What's while? Depends on how much money you had in there to begin with. If you had over $10,000, it has to season for a day. If you have less than $10,000, you need to season it for about 3 months. That's the only trick here. Otherwise, then when you're answering that question, when you're filling out the annuity documents, they're going to ask, did you borrow money to fund this? Because you can't fund the annuities with borrowed money. Okay? So that's why you need to make sure you season it and it becomes your money. So that is daisy chain annuity stacking. And that $10,000, that's easy to do. And that DFL, this illustration, just so everybody's on the same page, let me show you something. Do you see that? Joe Daisy Chain 350. This is a $350 a month DFL. Pretty much everybody can afford these. So now I'm going to shut this down. I'm going to open it up for questions now. Everybody got it. Fantastic. So I have, if anybody has any questions, I have about 7 minutes.
Scott, I'm sorry, my mind's a little bit blown by that last piece. I'm having trouble formulating a question for you.
Okay. Come on, Christian.
Hey, Scott, I'm just double checking. The money in the annuity is tax deferred, correct?
Correct. However, where's the money? So think about this. What kind of annuity is it? It's a Roth annuity. Because the money was non-qualified money.
Does that mean you're only paying deferred tax on the growth?
Yep, you're only paying tax on the interest.
Okay, thank you.
Okay. Everybody got it. Great.
Hey, Scott, it's Tay. I've got a question. Okay,
Hey,
I've
Tay.
done several DFLs, but the annuity part scares the holy bejesus out of me. So, I mean, I would say I'm a rookie. I mean, how would I even start approaching this to do this extra for my client?
So first off, words are important. So I'm using the word annuity here because we're in training, but make sure we use the right words for the right person. So there's lots of different things you can call an annuity. I like to use the word typically a private pension because that's exactly what it is. Okay. Or you can even call it an IRA because it is an individual retirement account. So how would you do this? It's just like the first time you ever wrote a life insurance policy, the first annuity, it's the same way. It's just a different set of questions. So don't be afraid of it. Just, go out and play with it. Go out and make a mess. Call the carriers. They'll help you do it. The Athene Performance Elite 15 is what I use to do this illustration simply because it's the fastest one I know to illustrate. I actually prefer the F&G Accumulator 14. It has a higher return and has a better index. But how much better? That number at the end would probably be maybe $1,000 more on the growth.
But Scott?
Hey, Laureen.
Hi, how are you?
I'm fantastic.
So for Tay, really what you're looking at is you're looking at that white space. So it's just setting the expectation. So, hey, Bob, whenever you get to this white space where you have a period of time, we can look at some ways that you can make even more money. So you're just whetting his appetite. You're not really trying to educate him on this at this point. by the time that that white space happens, Tay, you will be more experienced. So don't get scared.
Right, and that really is it on the illustration I just did for that gentleman. You're looking at you're not going to start doing that until after the debt's gone. So
okay.
that plan, the way I just illustrated it, was the first 3 years after the debt is gone. That's when you're going to do 4 annuities per year after the debt's gone. So you're still looking 6, 7, 8, 9 years down the road, depending on whether you're mortgage chunking prior to or not.
So it's still, you're setting the expectation that you're building in that longevity for you to come back to this client and help them even more.
Yep. Second, third, fourth, or in this case, 12 additional bites at the apple.
Right.
Okay. All right, folks. Well, hopefully you got something out of this. If you have any questions, you can, if you know how to get a hold of me, great. If you don't, just ask. I'm sure somebody knows how to get a hold of me. If you're here as a client, please take this with a grain of salt. Talk to the person who invited you here and talk with them, and I'm sure they can answer any questions that you might have. And until next week, we'll see you back next week. Thanks, everybody.
Thank you, Scott. Appreciate your time tonight. Have a great evening, everybody. Be safe out there.